The monetary policy. In the previous video, I break down how commercial banks make money. However, in this lesson, I'm gonna walk you through how the central bank manages the supply of money in the economy. Let's jump right in. To control the inflation and spurs growth, the central bank uses three powerful levers. What is monetary policy? This is the policy imposed by the central bank in order to control the supply of money in the economy. And there are two types of monetary policy: the expansion monetary policy and the contraction monetary policy. The expansion monetary policy is like hitting the gas pedal. By injecting some US dollars into the economy, the central bank is trying to fight against recession and lower unemployment. On the other hand, contraction monetary policy is like hitting the brakes. By sucking some US dollars out of the economy, the central bank is trying to stop rising prices, aka inflation. Let's now talk about three powerful levers. Number 1. Reserve requirement. What is reserve requirement? This is the amount of money a bank must keep as a reserve in order to meet its daily operation, and the central bank determines this amount of money. Visualize the $100 deposit. If the central bank sets reserve requirement at 10%, this means if you deposit $100, a $10 would be kept as reserve and a $90 would be loaned out. This $90 is the fuel that creates economic spending. But what happens when prices are skyrocketing? Would the central bank stick to the same required reserve? Absolutely not. The central bank would increase the required reserve in order to cool inflation. For instance, if the central bank raises the required reserve ratio to 20%, that means if you deposit $100, a $20 would be kept as reserve and an $80 would be loaned out. Look at this. Lendable funds drop from $90 to $80. Fewer loans means less spending, and if people decrease their spendings, prices stop rising as demand cools. Number 2. Policy interest rate. How does setting the price tag for every dollar borrowed in the nation affect the economy? Let's find out. The impact of interest rate shifts. With a low rate, home mortgages' monthly payments are affordable, but with a high rate, that's the opposite. With a low rate, businesses are easy to expand and hire, but with a high rate, it's very costly to grow, and businesses wait to hire. With a high rate, credit cards attract high payment for spending, but with a low rate, that's the opposite. With a low rate, it's not possible to save, but with a high rate, the possibility of saving is high. Let's now look at the final two. The open market operation. The bond market swap used to inject or suck out US dollars liquidity. The buying and selling of bonds. If the central bank wants to increase the supply of money in the economy, they buy bonds. Now commercial banks have massive cash to loan out. However, if the central bank wants to decrease the supply of money in the economy, they sell bonds. Now the commercial banks have less money to loan out. Let's now consider the pros and cons of monetary policy. If the central bank exercises the expansion in monetary policy, the GDP will grow. On the other hand, the inflation rate will rise. It's like hitting the gas. If you overdo it, you might cause an accident. However, if the central bank exercises the contraction in monetary policy, the inflation rate will decrease. On the other hand, the unemployment rate will rise. It's like hitting the brakes. If you overdo it, you might not reach your destination on time. So the central bank must balance these results to keep the economy stable. Do you have any questions on the monetary policy? Leave it in the comment section. Thanks for watching.